Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets.
Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. It has been almost exactly a year since I started the IceCap Canadian Market Wrap, and I wanted to take a second to thank everyone for joining me on this journey. Thank you for your time every single week and the trust that you put in me to talk about Canada and the Canadian economy. As the summer winds down with the hockey season around the corner, I thought I would try something a little different and switch things up this week and address a little bit of a pet peeve of mine, and that is the lack of Canadian focus on our taxpayer-subsidized media landscape. In my view, the Canada's macroeconomic and business newswire is annoyingly dominated by what's going on south of the border and in Europe. And so this week, I thought I would bang out a video about the top economic and financial market headlines and news items that every Canadian should be aware of. Some of these you might be familiar with, others less so, and if I've missed something or blessed something out that I should not have, put it in the comments for all our benefit. Going forward, I'm going to do a similar video once a quarter to complement my more narrative-driven hits. So let's get started. Inflation is not going away. This week, we got the July inflation print, and it was more of the same. You can check out all the gory details of the updated data on my Twitter account, but I'm sticking with showing you these two non-updated charts from the BOC's July monetary policy reports because they tell the bigger picture. Core inflation measures are still rising, and so is inflation breadth, and nothing we've learned this week has changed that. This sticky inflation is in part why the single mandate Bank of Canada has been reluctant to cut interest rates, and the OIS market used to calculate the probability distribution of future decisions remains in the 60% no-cut range. In truth, this is not very convincing in either direction and certainly subject to change. Why? Because the market, and myself included, do not think the BOC has the intestinal fortitude to stare down rising unemployment. And yes, the rise is most acute with young people, and we know the government doesn't care much about them. But the chart is here to show you that the labor market is softening full stop, and we expect year-on-year job growth to be negative by December or January. Further cuts, even as inflation rises, will push real interest rates into negative territory, which is good for asset holders and borrowers and provides air cover for even more government profligacy, stoking the next wave of inflation. Negative real rates are a transfer of wealth from labor to capital. And in my view, it is outrageous that we are sliding back into this bankrupt monetary policy framework, even when we're not in a crisis. Thankfully, the rest of the yield curve has something to say about it. The yield curve, in very simple terms, is just interest rates at different maturity. Each maturity tells us different things about the expectations for an economy. Again, very simply, the front or short end of the curve is monetary policy, and the long end is more about growth, inflation, and credit quality. With the long end rising, it is telling us that something is off. Given what we know about soft growth in the economy, it might be suggesting that inflation is heading higher, and there are concerns about getting your money back in real terms, akin to credit quality. Why this matters is because the federal government is about to hit Canadians with a big, beautiful budget, which is expected to be a whopper of a deficit. The problem Canada faces is that debt levels are already very high, and much of the debt issued over the past few years is coming due. This is true for the private and public sector, and this means that debt charges or interest payments will continue to rise because this debt will be refinanced at much higher interest rates or bond yields. Note that interest payments for the federal government are already higher than health transfers. So what about business sentiment? Well, we all know that manufacturers are not happy, and this PMI indicator supports that conclusion. Canada's manufacturing sector continues to struggle in the face of tariffs during July, with output, new orders, and buying activity all declining at noticeable rates, albeit to a lesser degree seen in recent months. In our view, the real issue remains the uncertainty rather than the tariffs themselves. Canadians were promised the deal and have seen their Prime Minister frozen out of trade talks, suggesting that there might be more pain to come. What's important to note is that this malaise in the business community has been an issue for a while. Yes, the cyclical downturn is due to the trade war, and this cannot be overlooked, but there has been a structural problem in the business community for many, many years. There's been little to no growth in capital expenditure, and this does not seem to be going away. This week, business sentiment is echoed by consumer confidence, which is also on the decline and is trending lower. And who can blame them? Jobs are harder to come by, interest rates are rising, inflation problem is not going away. Moreover, the GDP per capita has been flat for 10 years. Canada is in secular stagnation, and consumers that are unable to ride home prices higher are starting to feel it. On the housing front, we've got some good news, sort of. The number of home sales recorded over the Canadian MLS systems climbed 3.8%, building on gains from the previous couple of months. And these transactions are up since March. But the July increase in home sales was again led overwhelmingly by the Greater Toronto Area, which were at historical lows. But house prices are still very expensive relative to incomes in Toronto and Vancouver especially, and in many jurisdictions have only fallen back to 2021 levels. There are still a ways to go. As we bring it home, we can't escape how all this poor economic performance manifests, and the most obvious way is in the decline of the Canadian dollar, or loonie. As you can see, the Canadian dollar is down or at lows with respect to the US dollar, the Swiss franc, the euro, and the British pound. But today I wanted to leave us on a positive note, and that is one of strong equity market performance, setting us up for next week's video on the Canadian equity market in total. What's in it, what's not, what's driving the performance, and why it is decoupled from the economy. All right, so hopefully by now you guys know that I look at all kinds of economic data from Canada, like car sales, which have held up really well, money supply, which is rolling over, credit growth, which seems to be improving despite the fact that there are higher interest rates, the vacancy rates of jobs, which has collapsed, bankruptcies, which are really high, and of course, my favorite, productivity. So if you're curious about something, put it in the comments, send me an email, or follow me on Twitter, and I probably have spoken about it, or just go ahead and ask. Anyway, so that's a wrap on this week's episode. Please like, subscribe, and follow for more. Thank you again for supporting me through this year, and hopefully in the year to come. And as always, we manage money for families all across Canada and the world, so please feel free to get in touch.